Welcome everyone. Today we are going to explore an exciting tool that can really boost your trading confidence. We are diving into the volume indicator in RTrader Pro. This tool can help you make better decisions about when to enter or exit a trade. By the end of this session, you will understand how to set it up, how to read it, and how to use it in your strategy. This knowledge will help you feel much more sure of your choices. Ready to get started? Let us dive right in. If you have ever found yourself wondering if a price move is really as strong as it looks, volume can be the answer. Let us dive into what the volume indicator is and how it helps you understand market activity. First, let us talk about what the volume indicator actually does. In simple terms, the volume indicator shows the total number of trades that happen during a certain period. It helps you see how active the market is. This is important because the amount of trading tells you something about how strong a price move is. Think about it like this. If more and more people are buying or selling, that means more people agree on the direction. If there is a lot of trading while the price goes up or down, it suggests a lot of people are on board with that move. But if volume is dropping, it might mean people are losing interest. Now, let us connect this understanding of volume with specific chart patterns. Chart patterns are visual representations of price movements that help predict future movements. Some of the most common patterns include head and shoulders, double tops and bottoms, flags, pennants, and triangles. Each of these patterns tells a story about the battle between buyers and sellers, and volume plays a crucial role in confirming their validity. For example, let us consider the head and shoulders pattern. This pattern is a reversal pattern that can indicate a change in trend direction. The left shoulder forms as the price rises and then falls, usually on increasing volume. The head is the highest peak and forms with significant volume, while the right shoulder forms with weaker volume, indicating the buyers are losing strength. When the price finally breaks below the neckline of this pattern, a spike in volume helps confirm that the trend reversal is genuine. Another important pattern is the double top or double bottom. A double top occurs when the price tries to move above a previous high, fails, and then falls back, forming a second peak near the same level. Volume typically declines on the second top, which signals that buyers are losing momentum. When the price drops below the support level between the two peaks, a surge in volume confirms the pattern. A similar concept applies to a double bottom, where volume helps confirm a reversal of a downtrend. Flags and pennants are continuation patterns that show a brief pause in the market before the trend resumes. Flags form after a sharp price movement, followed by a consolidation that moves in the opposite direction. During this consolidation, volume often decreases. However, when the price breaks out of the flag and resumes its trend, you want to see a sharp increase in volume to confirm that the breakout is genuine. Pennants are similar but are characterized by converging trend lines. Again, a breakout with increasing volume indicates a continuation of the trend. Triangles are another common pattern, and they come in different forms: ascending, descending, and symmetrical. Ascending triangles often signal a bullish breakout, and you want to see volume increasing as the price approaches the resistance level. A breakout above resistance on strong volume signals that the buyers have taken control. Descending triangles suggest a bearish breakout, with increasing volume confirming the breakdown below support. Symmetrical triangles can break in either direction, and the direction of the breakout, along with strong volume, will determine the trend. Have you ever seen any of these chart patterns in your trades? Let us dive deeper into some additional chart patterns and understand how volume plays a role in each one. One significant pattern is the cup and handle pattern. This pattern resembles the shape of a teacup, where the cup forms after a rounded decline and subsequent rise, followed by a smaller consolidation or handle. The handle often forms on lighter volume as the price pulls back slightly. The real signal comes when the price breaks out of the handle on increasing volume. This increase in volume confirms the bullish sentiment, indicating that the price is likely to continue moving higher. Another important pattern is the rounding bottom, also known as the saucer bottom. This pattern indicates a long-term reversal of a downtrend and signals a shift to an uptrend. As the price moves down and begins to round out, volume usually decreases, showing that sellers are losing interest. As the price starts to rise again to complete the saucer shape, volume should begin to increase. A breakout above the resistance level formed at the beginning of the pattern on high volume is a strong signal that the trend has shifted to bullish. The inverse head and shoulders pattern is also a powerful reversal pattern. It is similar to the standard head and shoulders, but occurs at the bottom of a downtrend. The left shoulder forms with a price decline followed by a small rally. The head forms with a deeper decline, and the right shoulder forms with another smaller decline. Volume behavior is crucial here, as the breakout above the neckline should happen on strong volume to confirm the reversal. Without sufficient volume, the breakout might not be trustworthy. Another chart pattern to consider is the falling wedge. This is generally a bullish pattern, indicating that although the price is declining, it is doing so at a decreasing rate. The key signal for traders is a breakout from the wedge with a sharp increase in volume, suggesting that buyers are stepping in and a reversal is likely. Conversely, the rising wedge is a bearish pattern, usually forming during an uptrend. Volume decreases as the pattern forms, and a breakdown from the wedge on strong volume confirms the bearish move. We also have the rectangle or box pattern, which indicates a period of consolidation where the price moves within a set range between support and resistance levels. Volume often diminishes during this consolidation phase. A breakout from the rectangle, whether up or down, should be accompanied by an increase in volume to confirm the move. If the breakout occurs without sufficient volume, the price might fall back into the range. Understanding how volume interacts with these patterns can give you a much better idea of what might happen next. By combining volume with chart patterns, you can improve your confidence in your trades and better understand the market's direction. Volume is not just a number. It is a powerful confirmation tool that can make these patterns much more reliable. Now let us go a bit deeper into how volume and price interact. When volume is increasing, it shows more traders are willing to take part in the market at those current prices. This means the trend is probably going to keep going strong. For instance, if the price of a stock is moving higher and you see volume going up too, that usually means buyers are serious. But if the price is moving up and volume is shrinking, that might mean the interest is fading. Have you ever seen a price move that just felt shaky? Often, low volume is the clue that something is not quite right. To confirm if a trend is solid, we need to understand how volume behaves. When the price is going up on strong volume and then falls back on low volume, that is a good sign the trend might continue. It is a bit like climbing a hill. If you see people climbing quickly and resting a bit before moving on, you know they have energy left. If a stock price is rising and then pulling back just a little on low volume, it often means the buyers are resting before making another push. Now, let us expand on how these volume behaviors appear in different chart patterns. For example, in an ascending triangle pattern, we see the price making higher lows while being capped by a resistance level. When the price approaches the resistance with increasing volume, it suggests that buyers are gaining strength. If the price eventually breaks out above the resistance with a strong surge in volume, this confirms that the breakout is likely to be sustained. Without increasing volume, the breakout might be less reliable. In a descending triangle pattern, the price forms lower highs and tests a horizontal support level. Here, volume usually picks up as the price approaches support. A breakdown below the support level on strong volume indicates that sellers are dominating, confirming the bearish breakout. When volume is weak during a breakdown, the move could potentially be a false one. Symmetrical triangles can break in either direction. Watching volume here is crucial. As the price consolidates, volume often decreases, reflecting indecision among traders. However, when the price breaks out, whether upwards or downwards, a spike in volume will confirm the direction and strength of the move. In wedge patterns, which can either be rising or falling, volume often decreases as the pattern progresses. A breakout from a wedge should be confirmed with a noticeable increase in volume to indicate a strong move. Rising wedges often indicate a bearish reversal, while falling wedges typically suggest a bullish reversal. If a price forms a flag after a sharp upward move, volume during the flag's formation tends to decrease, reflecting a pause in the trend. However, when the price breaks out of the flag, a significant increase in volume is often seen, confirming that the original trend is resuming. The same concept applies to bearish flags after a sharp downward move. Have you noticed anything like this before in your trades? Understanding how volume interacts with these specific chart patterns can give you a much deeper insight into whether the trend will continue or reverse. Keep an eye on these volume patterns, and you will start to feel much more in tune with the market. Another thing to keep in mind is how volume can help you spot a reversal in the trend. Often, when a price is about to change direction, there is a sudden spike in volume. This tells us that traders are rushing to make their moves. They want to get in or get out because they think something big is about to happen. A common clue to watch for is called volume divergence. This happens when the price is still moving in one direction, but the volume is telling a different story. For instance, if the price is making new highs but the volume is dropping, it could mean the move is losing power. Have you ever noticed this kind of divergence before? It can be a really strong hint that the market is about to change direction. There are also some special tools that use volume to give you extra insight. One of them is called on balance volume. On balance volume adds up all the volume on the days when the price goes up and subtracts it on days when the price goes down. This helps you understand whether money is flowing into or out of a stock. Another one is called the volume weighted average price. It calculates the average price of a stock throughout the day, but gives more weight to times when volume is higher. This can help you see if a stock is trading above or below what might be considered a fair price. There is also the money flow index, which uses both price and volume to tell you if a stock is overbought or oversold. It can be a great tool to spot when a price might be about to change direction. Additionally, the accumulation/distribution line is another tool that combines price and volume to help determine whether a stock is being accumulated bought or distributed sold. This indicator can be particularly helpful for confirming the strength of a trend. Another valuable indicator is the check-in money flow. It measures the amount of money flow volume over a specific period. Positive check-in money flow suggests that buying pressure is stronger, while negative values indicate selling pressure. Watching this indicator alongside price movement can give you a better idea of when momentum is shifting. Volume profile is another useful tool. It is a horizontal histogram that shows the volume traded at different price levels. It can help identify areas of strong buying or selling interest. These areas, often called high-volume nodes, can act as significant levels of support or resistance. Have you ever tried any of these volume indicators? They can be really useful for getting a more complete picture of what is happening in the market. By combining these indicators, you can gain a deeper understanding of market sentiment and improve your trading decisions. For example, you could use on-balance volume to determine the direction of money flow, while simultaneously using the volume weighted average price to identify whether the stock is trading above or below its average value. Adding the money flow index can help determine if a stock is overbought or oversold, adding an extra layer of confirmation to your analysis. Combining multiple indicators like this not only enhances the reliability of your trading signals, but also provides a broader perspective on the overall market conditions. Let us now discuss how volume plays a role in price breakouts. When a stock price breaks through a level of support or resistance, volume is really important. If the price breaks through and the volume is high, that is usually a good sign that the move is real. If the price breaks through but volume is low, it could mean that the move will not last long. Imagine you are watching a stock that is struggling to break above a key level. Suddenly, it pushes through and volume surges. That is a signal that many traders agree that the price is likely to keep going. How do you usually confirm if a breakout is real or just a fake move? Volume can be a great confirmation tool. When the market is not really trending but is stuck in a range, volume behaves differently. During these times, volume often drops off because traders are waiting to see what will happen next. This type of movement is often referred to as a consolidation phase, where traders remain hesitant and no clear direction is established. If the market is moving sideways, you should pay attention when volume picks up near the edges of the range. This can tell you that a breakout is coming. For example, if you notice volume increasing significantly as the price reaches either the resistance or support levels of the range, it might be a signal that traders are positioning for a breakout or breakdown. Imagine a stock that has been moving in a narrow range for a while, creating a well-defined area of support and resistance. If you see volume starting to increase near a key level, it might mean that traders are getting ready for a big move, and you should be prepared to act accordingly. There are also different types of range-bound patterns where volume plays a crucial role. One common type is a rectangle pattern, where price moves between horizontal support and resistance levels. When the price approaches the resistance or support line, an increase in volume can hint at the possibility of a breakout. Another type of pattern is the horizontal channel. Similar to rectangles, channels provide clear levels where buying or selling can occur. If volume spikes as the price reaches the top or bottom of the channel, it may indicate that traders are ready for the price to move out of the range. Another interesting pattern in range-bound markets is the accumulation or distribution phase. In the accumulation phase, volume tends to be higher at the support level, suggesting that buyers are stepping in. In contrast, during the distribution phase, volume tends to increase at the resistance level, which suggests that sellers are dominating. Recognizing whether the market is in accumulation or distribution can help you anticipate the direction of the eventual breakout. Have you found yourself trading in a range-bound market before? It is critical to understand the context of volume in these situations because volume acts as a key confirmation for predicting upcoming price movements. Keeping an eye on volume might help you see when the action is about to start again and whether a breakout is likely to be sustained or if it could be a false move. There are some common mistakes that traders make when using volume, and it is important to be aware of them. One mistake is to put too much focus on volume by itself. Volume is a powerful tool, but it should not be used alone. Always combine it with other indicators and price action to get a clearer view. Another mistake is to think that all low-volume moves are weak. Sometimes price can still move in the right direction even if volume is light. Have you ever seen a stock moving higher even though there was not a lot of volume? It is always a good idea to consider other factors too, like trend strength or any news that might explain the move. Now let us talk about how to use volume in different types of trading. For day traders, volume is very helpful for spotting quick opportunities. If you are trading during the day, you will often see volume spikes as the price starts to move. These volume spikes can be great signals for getting in or out of trades. One of the key chart patterns for day traders is the breakout pattern. When a price breaks through a key level like support or resistance, a strong spike in volume confirms the breakout. For instance, if a stock breaks above a resistance level with a sharp increase in volume, this is a signal that the move is likely to continue, providing a good opportunity for day traders to enter. If volume is low during a breakout, it could indicate a potential fakeout, which day traders should be cautious of. Swing traders who hold trades for several days or weeks use volume to see if a trend is likely to continue. They look at how volume behaves over several days to see if a trend is still strong. Swing traders often focus on patterns like double tops, double bottoms, or triangles to identify opportunities. Volume is crucial in confirming these patterns. For example, if a stock forms a double bottom and the price starts to move higher with increasing volume, it signals that buyers are stepping in and the trend reversal is genuine. Conversely, if volume is weak, the pattern might not hold and the stock could continue its previous trend. Swing traders also watch for volume during retracements. If the price pulls back on low volume after a strong uptrend, it can be a sign that the trend is still intact and an opportunity to add to a position. Longer-term traders also pay a lot of attention to volume, especially at key levels. High volume at a major support or resistance level means the trend might stick. Longer-term traders often look for chart patterns like head and shoulders, cup and handle, or long-term support and resistance zones. For example, in a head and shoulders pattern, the breakdown below the neckline should be accompanied by high volume to confirm the trend reversal. If volume is weak, it might suggest that the breakdown will not have lasting power. Similarly, longer-term traders monitor accumulation and distribution phases. If a stock is in an accumulation phase and starts to break out with increasing volume, it suggests a strong trend may develop. How do you adjust your strategy based on how long you plan to hold your trade? Volume can help you in each situation by giving you more confidence in what the price is likely to do next. Whether you are a day trader looking for quick moves, a swing trader aiming for a trend continuation, or a long-term trader focusing on major trend reversals, understanding how volume interacts with different chart patterns can significantly enhance your trading strategy. Let us go through a quick example to see how volume works in a trade. Imagine you are watching a stock that is getting close to a resistance level. As it gets near that level, you see volume start to pick up. This means more buyers are interested and the price is likely to break through. If the price does break through and volume stays strong, that could be a great time to enter a trade. Now, let us say you are in the trade and the price is moving up. If the stock starts to pull back but the volume drops off, that means there is not much selling pressure. This could be a good reason to stay in the trade. But if the pullback happens on high volume, that might mean it is time to exit. Does that sound like a plan you could try using in your own trading? To wrap things up, the volume indicator in RTrader Pro is a powerful tool that can help confirm price movements and identify trends. By adding volume analysis to your trading strategy, you can make much more confident decisions about when to enter and exit trades. It is simple to use but can give you a lot of insight into what is really happening in the market. Start practicing with volume analysis and see how it can help you improve your trading skills. Keep an eye on volume, stay curious, and happy trading, everyone.